I've been pursuing an interest in investing over the last few years. I've read a lot of the works of great value investors such as Seth Klarman, Charlie Munger, Warren Buffett, and Howard Marks. And what I've done is sort of analyzed what they're saying and condensed it, and put the learnings that can be taken away from that, or the learnings I find interesting from that, onto my blog, which is tagged below. Having read a lot of content, I thought it would be interesting to create some content myself. And I've decided to do an investor series where I'm going to interview a series of investors who have different investment philosophies, invest across different asset classes, and essentially try to learn how they think about investing and what they think someone trying to develop an interest in investing should do to further that interest. So this is the first of this series of interviews, and I'm going to be interviewing Vinod Nair. He is a managing partner at Altavista Investment Management, which manages a global equity long-short fund. I'm sure it'll prove to be a really useful video. To begin, I would like to ask you how you developed your interest in investing, or sort of when you began to get interested in it.
Right. I think it started for me fairly young. My father got first interested in investing way back in the 80s, when I was probably 10, 11 or so, because that was roughly the time when investing in primary issues became a thing in India. There was a lot of TV and press advertising. This was the time when Dhirubhai Ambani had come out with Reliance and direct communication to the masses to invest in as stock. So my father used to invest in the odd IPOs, and then I was curious about what those were, and it sounded very fascinating because it was, you learned a bit about the industries from fertilizer all the way to steel, etc. So that kernel of interest started at that point. Then obviously when I went to business school, I was quite interested in all the finance and the economics and investing type subjects. So I did my summer training at DSP Merrill Lynch, where I spent about 4 weeks doing equity research in their sell side division, and that reinforced, the kind of work that is the backbone of investing. So that's where the original interest started. And then progressively, as I moved into this as a full-time profession, post my consulting experience, is where really the whole journey started.
So, during the process of sort of beginning to develop an interest in investing and sort of investing money, you kind of end up developing your own investment philosophy as you go along. So, I realize that it's a constantly changing philosophy, but as of today, how would you think about a company, or what is your philosophy today?
Right. I guess I have always been a value-minded investor. It's always been a firm belief that the reason you make alpha or money in the stock markets is because you're buying something that's undervalued.
Mm-hmm.
The thing that has changed for me over time has been that I appreciate the value of quality and superior returns on capital in a business, as opposed to being purely valuation minded. Because there are cheap stocks which are not the greatest of businesses, and then there are good quality businesses which are undervalued for what it is, and I've increasingly moved towards the latter.
Is there a reason for that?
The reason for that is, as you spend time, there's a philosophical angle to it, which is, if your great purpose in this whole economic machine is to allocate capital towards high good users of capital, then your purpose in life is to allocate it to the people who generate superior returns on capital. But then I also feel like if you're a contrarian investor or a value investor, you should have names where your conviction improves or doesn't go away when bad things happen to a stock. So usually when you're buying a undervalued stock, it's because there are short-term issues, and those issues you can never pick the bottom. So maybe after you own it, more issues surface. And I find that every time, if I wonder whether this business should fundamentally have existed or should, defend its profit pool, etc., that conviction, I need to have a strong conviction to whether the questions that are asked to me when the stock is not working. And I want to be in a position where I can double up. So that has also pushed me towards this quality, saying that if it's a poor quality business, when things are going bad, I always feel my conviction. Exactly. And then finally, I guess I also have increasingly started being more believing into portfolio concentration. Because I feel like in a 60, 100 name portfolio, you really don't have real conviction and knowledge. You're just playing your bets. While if you have a 10, 15, 20, 30 name portfolio, then you can at least keep on top of what's happening in each story. And you would never feel comfortable investing, maybe 1/10 or 1/20th of the portfolio in a name where you really are not a long-term believer in the story. So for a variety of reasons, I've moved towards this. It has to have high quality, but obviously the only reason I'm making money on this high quality business is because it's undervalued. Can I understand what are the drivers of undervaluation? Can I conclude that the quality of the business is not tainted by the near-term issues? And if I can build a portfolio of high quality undervalued stocks, I will generate alpha.
So you said that you believe in a concentrated portfolio. For somebody who's just starting out, what would you say is the right number of positions to have?
Okay, I'm sure there is academic research on this topic, but I've felt like I have seen people who run 10 name portfolios. I've seen people who run 100, 200 name portfolios. For me, it is more, maybe 25, 30,
Okay.
35, 30 names. It's more determined by my own bandwidth. How many can I be on top of at the same time? And secondly, good opportunities are scarce in a fairly efficient market. So by the time I find that, even getting those 2, 3, 4, 5 ideas that you need every year to keep your portfolio fresh is a challenge. And so short answer is 25, 30 for me feels like a reasonably diversified.
Okay. So, you've already said that you look for quality, valuation, and looking for answers to difficult questions, and then how convinced are you about the potential for a good outcome? So sort of excluding those, if you were looking for 3 key metrics which are sort of signs of a really good business, what would those 3 or maybe more metrics be?
Right. I guess the metrics would be more, if you think of the buckets of metrics that you want, one is the quality, and next is, let's say, the valuation. On quality, I guess the biggest metric for me is, is this a high return on capital business? And then is the incremental return. It's not depending on its laurels, but even the current capex or investment that it's making is a very high return on capital. Now, obviously, the only reason a business makes high return on capital is because of a variety of industry structure and conduct reasons. So that brings you to other variables like, is this a growing business? Are you a market share gainer? Why do you gain market share? What is the moat? Is it because you're just tremendous scale, you have the best cost position? Is it because you've spent so much in A&P or R&D that other people find it difficult to replicate? So you need to have something that protects you from competition. So you can think of some of those metrics, but all of them finally fold into this concept of, is it a superior return on capital, industry and business? And then I would say on the valuation side, it's fairly straightforward. It's more, what there are tools to figure out what an appropriate value for this business is, and are you getting it at a much cheaper price than that? For me, more than the numbers, it's more interesting whether you understand why you're getting the bargain. Right? Because numbers can tell you whatever, but do I know that there is some pain in the market, which is why the stock is on offer, and do I understand it well enough to take the opposite position?
So you said that you've gone from earlier. You said you've gone from sort of a very core value focus to good quality businesses at good prices, and then you also said something about R&D and a business which is gaining market share or a growing industry as a whole. So would you say that growth is more important than value, or how do you find the middle ground?
I don't no. For me, growth is a part of the quality of the business. I'm not seeking just growth for its own sake.
Okay.
Obviously, a higher quality business has growth, some growth. It's not a declining or a stagnant kind of business. But whether a company grows 20 is better than a company that grows at 10, I wouldn't say that. I would just say growth is good, but what is the valuation in conjunction with it? If a 10% growth company and a 20% growth company, both with superior returns on capital, and then I have to choose with the same valuation, then obviously I choose the higher growth. But it is not, the growth and value, it is appropriate value for the appropriate growth. Nice. What I would avoid is probably declining businesses, stagnant businesses, because frankly, those are the businesses which tend to have extreme competition, and given fixed costs, you're fighting against that deleveraging that happens.
But surely, in a declining business, if everyone knows it's declining and it's very undervalued, it could actually be a good.
Absolutely. So pure value, which is where I was coming from, is a standalone great strategy. The problem which happens, and it's a personal thing, right? And a lot of people do that really well. For me, I find that if I have that kind of business declining profitability cheap, but something happens, let's say a big new player comes in or some regulatory change happens, which again shocks the company and it goes down 20%, it becomes even more cheaper. At that point, my worry is the way I will react to that is throw in the towel and say, I already had concerns about this business. Maybe I don't fully understand, let me get out. Contrast that with a great business where I fundamentally feel that this is going to be a winning model. There's more likelihood that a 20% correction, I would, have done all the numbers, but then I will say, I see what the market is worried about, but my conviction in this case has become higher.
Yeah.
The other problem I have goes back to this concentration thing that I was talking about. So if you buy those kind of businesses, you don't want to put 10% of your money into those kind of business because you feel that, it could go to zero as well. It's a melting ice cube. I'm happy to take a 1%, 0.5% position in those. So when I was doing deep value, it was a lot more diversified portfolio because in some ways you're betting on the cheapness rather than the company. You're spraying your bets on a lot of cheap companies, and hopefully none of them will kill you, but as a factor, a cheap stock will do better. And it's a completely valid strategy. It's just I have grown off based on my own behavioral characteristics.
Okay, so which of your qualities as an individual would you say has served you best as an investor and then in life in general as well?
Life in general, we shall wait and see. But as an investor, I think I'm reasonably phlegmatic and detached. I think the biggest problem with the markets is, you get your emotions. It's a very intense involvement that you have. And, while there is a part of our job which is very analytical and, um, you know, scientific, I would say. The rest of it is very emotional and behavioral. And for me, the fact that I'm fairly calm, phlegmatic, has helped me in good stead. That I can do all the analysis and deal with the ups and downs of the market in a fairly calm manner. I guess the other characteristics are more, to that I would say is the main thing. The other things are one needs to be fairly analytical in this job. You need to have the patience to read a lot, sit in front of a computer for vast periods of your day, read annual reports for a living. It's not the most exciting of things for a lot of people, but for certain personality types that works. Yeah, and
So going back to you said having emotional control over yourself. How do you? I mean, some people are just detached, by nature,
yeah,
which may be what you were trying to get at. But if that's not how you are, are there things you can do to attempt to become slightly more calm and sort of careful in the way you're reacting to the way things go?
I don't know. I have always been this way, and probably that's what makes it a fit. If you're not that kind of person, I'm sure in the margin you can, the market will train you a bit. But if that is fundamentally not who you are, it's a challenge in this profession. I think the best people have that ability to, when not throw in the towel when there's blood in the water and not get completely carried away. My previous firm, the boss used to say that this is the industry where you have the lowest of the lows and the highest of the highs. There are days when you think you're the biggest muppet on the world, and there are days when you think you're just the genius, right? And the reality is not, neither of the two is true. But that is how it makes you feel. And if you can't deal with that, you get carried away on either extreme, then you are probably not a fit with the industry.
Okay. So, having looked at which qualities have served you best, what would you think has been the most significant sort of hurdle to get over in order to make sure that you're doing the right thing?
I guess in investing, it is always it's a fine balance between having conviction and being balanced. So if you are completely balanced and do nothing, then you will see the pros and cons of everything and do nothing. Similarly, if you're purely conviction and not balanced, then you might not look at the bear case or for every stock if there's a buyer, then there's a seller as well. So you need to have, so that fine balance is what one keeps working on a daily basis. Can I build a conviction but be open-minded enough to know that there are people and other people's opinions on the stock have merit, and I have to understand and have a counter to that. That is, for me, been the continuing challenge or continuing thing to work.
So, with regards to getting, having conviction and still remaining unbiased, how do you, so you said you read opposing analysts' views as well. But how exactly do you go about that in terms of, would you have a discussion with somebody with the opposite view, or is it just reading?
I think it is all of the above. So A, you are open to, what is the bear argument. If you're investing in a stock, read the biggest, people who are negative on the name. But also, in our setup, it is a team and a consensus-led approach where every person can express their opinion, either in the investment decision-making group or as a broader group. Every Monday we have a discussion and people propose, suggest, or describe the investment thesis on the stock, and everybody has who can express a different opinion. So it's a combination of all that, but it's more of a mindset because you're very very convinced about something, but you're open to. It's a challenge for.
I guess the biggest challenge is probably while being open, you still have to take action. Right?
Exactly, and it's a difficult thing. So you can open up, but you don't want to lose the the ability to take a decision.
Okay, so
on that, it's also keeping yourself open to the possibility that you're wrong, right? You're not every time a stock doesn't work for you, you don't just you don't fight it always. You just say, okay, things could have changed. Can I look at this afresh? Can I maybe bring a untainted mind to look at this problem, and then be completely open-minded? Am I willing to, am I happy to? Is my ego strong enough to say that I made a mistake and let me move on, or am I holding on to my ego and saying that I have to be right and the market is wrong?
So going back to sort of exactly what you said right there, how do you know when when something isn't working out? How do you know that it's time to sort of call it a day?
That is a very very challenging thing to do, but the only thing you can do, and it's a difficult battle, but what you can do is you always outline the thesis that you had, and what you write it down as to this is why I'm buying the stock, this is why I think it's a good quality business, valuation, etc. And then track it. Maybe if the stock is not working, go back and ask those questions again. Do you still believe in it? And have the what do you call it, modesty, or accept that in this business your strike rate, hit rate is going to be 50-60%. So there's a high likelihood that a lot of times you are wrong, and you course correct whenever that happens.
Okay. So what mistakes would you say you've made in your investing career so far, and what can be taken away from those mistakes?
I guess broadly I would say the mistakes, by and large, you always make some analytical mistakes where you have not factored in all the issues that you should have thought of, etc. But that is, as a systemic issue, I guess one would love to have the ability to correct, to our earlier discussion, when your thesis is not working out, can you cut it and move on to the next thing? That ability to do that, the good thing about being a value investor is you tend to be contrarian, you're willing to take the opposite view. The problem is you also, therefore, your strength becomes your weakness because you fight. If things go against you, you should fight it. But so that's probably the one area one would like to improve a bit more. That you want to be holding to your convictions, but be more willing to cut loss or move on if things are not working. It's an ongoing area of improvement. So we force we can put rules like, if it doesn't work, let's have a discussion. Let's be open to saying, ask the question whether, if you have to put on the position now, assume you don't have the position, would you do it? So there are a lot of questions you can ask yourself to force and improve on that direction. But that, I would say, is an area to improve.
So, for somebody who's just starting out and sort of beginning to develop an interest in investing, how can you sort of, try to develop the right judgment, because it is at the end of the day a judgment call about when you're willing to continue to be contrarian and when you're going to take your loss and sort of move on.
I guess there's no substitute to actual investing. Because to me, investing feels like a fairly personal. It has, what you do, your strategy has to be aligned with who you are and what you believe and how you react to things, and that you can only get through actual participation in the market and feedback. That this kind of thing doesn't work for me, I don't behave properly. So A, participation in the market, B, being honest with yourself and doing a post-mortem of things that work, things didn't work, what did not work. There's a luck component, accept that. But aside from the luck component, what did you learn? So having a learning mindset, participating in the market, reading widely, because this is frankly, investing is probably requires the most. You're not only doing economics, you're doing behavioral psychology, you're understanding, commodities, you understand, it's a culmination of, it's a synthesis of a variety of bodies of knowledge, and so having a wide reading helps, having a wide range of frameworks to think helps.
Okay, I think that leads us very nicely into the last question, which is how do you sort of build an interest in investing as a whole, and other than obviously actually investing, what can you do in order to develop your interest, or figure out if you have an interest for that matter?
Right. I would again go back to the reading bit, which is, there are lots of good books on investing, experiences of a lot of good value investors especially. So read that, read about the markets, read the newspaper, The Economist, etc. And then follow the markets. That's probably the best advice I would give.
I really enjoyed doing the interview with Vinod Nair. I think it was a really insightful video, particularly the bits where we're discussing value and growth and how you have to get good quality businesses at good prices. I also really found the balance between being contrarian and being open to the fact that you're wrong very sort of challenging and insightful. I hope you found it useful as well. I'm sure you did. I look forward to doing the next one.